G'day guys, welcome to 2025 in wrap. Scott and I are going to have a bit of a chat today about some of the superannuation retirement planning wins that we've seen from the previous year and some themes that we've seen from clients and stuff coming through, and also a bit of a hot take on what we expect for next year. Strap in and let's get the Christmas episode out of the way.
It's always that time of year. My emails, and I'm sure you've also got a bunch of random wrapped emails. I think my council sent me a 2025 wrapped, I was like, okay, we're not saying we're jumping on the train. We did this last year. We did one in 2023 as well. So I'm not saying we're the innovators, but this is a good opportunity to take stock, look back over the last 12 months, see what's happened around retirement, superannuation, what's changed, what didn't change as well, which I think is kind of interesting. So a couple of things where that did occur where we thought there was going to be changes, but nothing actually changed. Actually, nothing actually happened. So Phil, let's get into it. What's on your mind?
What's on my mind? I don't know. It's been an interesting year. Yeah, I mean, big thank you first and foremost to everyone that's watched our podcast and booked in to have a chat with me. I've spoken to a hell of a lot of you, which has been great. But there's been some interesting themes that have emerged, which I think that's been a bit of a theme for me this year. I've seen a lot of people, probably off the back of some of our episodes we've done around tax and timing around sales, asset sales and that sort of thing, with a lot of people coming in saying, I've worked really hard, built this great share portfolio, property portfolio, insert whatever, large asset portfolio, and they've done really well. Clearly great savings, built a really great wealth position. They come in asking me what can we do to move it into more tax effective structures, or how do we sell this stuff more tax effectively? And in a lot of the cases for a lot of ones I've seen recently, the answer's been, well, get advice 20 years ago. And so that's been an interesting one to see. And a lot of these people have had, and I'm not bashing accountants here, so don't jump on me. There's some very good ones out there, but a lot of these people had been paying accountants for years that possibly maybe should have suggested some better setups along the way. So that's been a big theme for me this year. Just the benefit of hindsight, I suppose, and what things could have been done to potentially avoid some issues. So that's probably my hot take from this year, and a lot of the people I've spoken to is probably get advice earlier than you think you need to, whether that's financial advice, accounting advice, whatever, because sometimes by the time all the work's done, it's too late.
Yeah, you can't unscramble an egg, can you?
No, you can't. Well, you can, but it might cost you a lot in stamp duty and CGT. What about you? Any themes?
Well, I mean, yeah, I should say gratitude. Thank you so much if you're listening to this podcast. We've had really a great growth, and obviously we've hit a nerve, and it's been a pretty. I would say it's been a pretty wild year for both of us from fairly humble beginnings. I mean, the business structure hasn't changed that much since 2020 when I set it up, but the team's 3 times bigger than it was 2 years ago.
Yep.
And we've got a professional year advisor, Dan, who's starting on the 14th of January. He's been with us for 12 months in like a junior role, but he's now going to be stepping up and he'll be a fully fledged advisor, which is great. So I'm enjoying training him on sort of the Scott way of doing things. And I know there's certainly a Phil way of doing things as well that by osmosis he's taking on board. I think just reflecting back on from a portfolio perspective, those people that were rewarded were really investors within the WealthLab portfolios. We've done really well again. Like we said, there's nothing worse than having our clients quoting ourselves back to us. But in 2024, I was telling clients, hey, look, this type of growth is not normal. We've got great, portfolios positioned really well. We're happy. But you can't expect this type of portfolio figures to continue. And then here we are in 2025, and it did. And we've still had, we've had a couple of double-digit years, which has been fantastic for our clients who have been in the balanced growth portfolios, which means that they still have a fair bit of cash, fair bit of fixed income. So it means their equity positioning was actually really running hard. We set those sales up to capture that growth, and I've been really pleased looking back how that was set up. And if you're listening to this, the 2025 really punished those people who were sitting on the sidelines. If you were in cash, if you weren't quite sure, and the same thing that happened in 2024 as well was just punishing those people with just brutal inflation. Obviously, this year and off the back of last year was cost of living as well. We just everything's just been expensive. Off the back of our podcast we did the other day on cost of living internationally as well. So it's not like it's just in Aussie, but buy a cup of coffee in Bali, Vanuatu, Thailand, because we were just literally just doing these figures. It's similar. It's almost the same cost. And everyone's feeling it. And that means inflation's got faster, which meant those people that didn't invest have been really hurt.
Yeah.
So I would congratulate those people who have got active portfolios. If you've got a share portfolio, if you've been going into property, if you've been come to investments, you have been rewarded, hopefully. So well done you for doing that.
I might jump on my favorite high horse too. And if you're still stuck in one of those crappy Lifestage funds that's got you super conservative, or you've still got 10 years left before you retire, take a look. You probably got hurt for it.
Yeah. So just clarifying, Phil, what's a Lifestage fund? How does it work?
Yeah, look, there's a bunch of variations of these things out there, but very typical setup would be start out relatively aggressive while you're younger, and they become more conservative as you get older.
Which means they have worse performance.
Yeah, typically, yeah. And look, that's not the case across all life stage markets, across products across the markets. I'm not going to tar them all with the one brush, but there are some out there that get really conservative really quite quickly. I've seen clients come in getting, sub 4% returns, which in the last year, like market cycle, is just absolutely ridiculous.
I mean, inflation was nearly there anyway. So they basically just went, they could have put cash under the mattress, would have had a similar result. No, actually, no, they wouldn't have. But anyway, it wouldn't have been as good as a conservative or a balanced investment portfolio with that.
No, exactly right. Yeah. So it's been a beauty. It's actually been a funny year too, because while markets have been really good, performance overall has been great. There's been a few hairy moments along the way. I think back to all the tariff chaos that we had earlier in the year was actually for me, quite a cool moment actually, because I'd done a lot of work with a lot of retiree clients around portfolio structuring, risk mitigation, and a lot of education around, right, don't panic when things go red on the news and all that sort of stuff. And then when all this chaos hit the markets, I picked up the phone, I rang them all, and every single one of them had the same answer. Yeah, Phil, you told us, all good, don't need to talk to you. Which for me was just such a good validation of kind of the process and the thought and the education I've been providing to clients. Yeah, it was really nice to actually be able to make those phone calls in fairly choppy waters and have people just feeling completely comfortable. I thought that was great.
I think I definitely had 2 or 3 phone calls where people were like, hey, Scott, is now the time we gear up and go and buy more? And I went, oh my God, it's like, Jesus, all right, just you're doing a lot of podcast listening. I love it. Great. If that's what you want to do, then giddy up. But I actually think it was a bit of a blip. I feel, like everything, the tariffs, the US election, these types of moments were they're very hot at the time. But then like 8 months later, you're like, oh, wait, what was that?
I think all the tech stuff, the Mag 7 stuff was a bit of a wild one. They wrote off something like 150 trillion between them over the course of January.
They keep setting world records going up or down. So if you just have a 5% move in NVIDIA, it's just world record up or down.
That's what's wild, because it's sort of had this massive like 150 trillion. We're not talking a small amount of money here, but it seemed like 3 months later, everyone had forgotten and was just buying up again.
Isn't it weird?
It's crazy.
Yeah, well, I think it's also about maintaining a portfolio where you don't have a huge outlet. So, look, we have portfolios that have allocation to the. By Phil saying the Mag 7, that's Oracle's like one of the best performing stocks in the market, but it's like 80 years old or 50 years old or something. It's been around forever. The government's it runs most mainframes. In terms of Australia, we had superannuation go up to 12%. That has been ratcheting up for the past, 6 years now?
Yeah, yep, something like that.
And so we're now seeing a huge amount of money rolling into the stock market on a fortnightly, monthly basis. So basically 12% of the entire salary pool is going into the Australian and international stock markets.
Yeah, it's incredible when you think about it.
Isn't it? So now we're the second largest retirement pool on the planet, with a population of 26 million people. It's a wonderful thing, though, I think, because we're really genuinely getting to a point of having self-funded retirees. And if you're probably listening to this either thinking about your superannuation or you probably got it sorted. Not having to rely on the teat of the government is one of the best things you could possibly do. And having that capacity to grow and be focused on, you don't like that reference, do you?
The teat of the government.
That's what you're doing.
Yeah, well, it's true.
You're sounding like, please. I think in terms of the age pension, we had some means test increases within line with inflation. So that kicked up. And we also had the ASFA, which is the Australian, what does it stand for? ASFA Financial
Superannuation Funds Association.
They launched their cost of living, basically what they expect a couple to be living off. That came out this week.
Yeah.
Phil, do you want to just touch on what those figures look like?
Yeah, I don't have them in front of me now. It's 78,000 and something, 78,000 and change for a couple. It's gone up from 73,000 in the March quarter. So that's a pretty steep increase over a course of 3 months.
That's a big movement.
Yeah.
In terms of an investment portfolio, that's quite a lot of additional investment you need to offset that just being static. And at that 78,000 passive income, it's pretty hard to generate that. So a lot of people are actually drawing down their super balances at that level. So you need to be sort of focusing on that one. I thought that was kind of interesting to come out with. And then my final point, which is the longevity. I think the Australian age of death went up by an extra year. So now it's like, I think it's 83 for women and 81.5 for men. So we're living longer as well, which has been an interesting one. So
live longer, everything's going up one more. That's great. Good combination. Yeah, that's interesting. That probably ties well into my next point about things to watch out for next year, I reckon. Tell me about inflation. Like it's being sticky. It hasn't really buggered off. Well, I guess after all the rate cuts, kind of things have started to ratchet up a little bit. So depends on who you listen to and which banks you want to follow. But, a lot of the major banks are starting to tip that and the Reserve Bank's kind of hinting that we might be looking at a few rate increases next year. Whereas, 6 months ago, we were talking about more cuts, which is very interesting. So that's probably something to watch out for next year. I find it a bit concerning because we've got this idiotic legislation that's come in with the 5%.
Tell me, Phil, tell me more about the 5%. Be specific.
Well, so 5% first home buyers deposit, you don't fix the supply problem by stimulating demand. All it's probably going to do is move more money out of young people. So if you think about it, the potential, or just what I see as the potential problem here is that we've now got a lot of young people that are at the earlier part of their career, potentially lower earning capacity. They've had to go and borrow $1 million for a standard family home in the suburbs somewhere, which is just unbelievable to begin with. And now they've done a 95% lend on it. So they've borrowed 95% of the value. And then we get a couple of rate increases. That's a recipe for disaster. I'm probably seeing some parallels to 2006.
If you're a little bit older, if you remember it, but like you only need a 5% drop in the value of the property, and you're underwater.
Yeah, yeah, which happened to a lot of people.
How many times have we told them? We've had this chat with people a lot. Like properties go up and down by more than 5%. They do.
Yeah, everyone's forgotten it. After the COVID spike, but I don't know, and maybe nothing happens, but I think we're in a bit of a precarious position at the moment from that sort of perspective. It's definitely interesting. I wouldn't want to be 25 with $1 million mortgage at a 95% lend right now.
Borrow $1 million, you pay $2.3 million in interest over the lifetime. Repay back 2.3 total. It's just brutal. Look, I would also avoiding the sort of 2025 mistakes that we've seen, the set and forget trap, people neglecting their portfolio, not rebalancing appropriately. So what's happened is we've seen other advice groups, not ourselves. They were certainly very long US equities in the beginning of the year, and they didn't rebalance. So we were at a conference and we saw people talking about rebalancing. That set and forget trap is something that we've seen didn't work, and we will continually be talking to our clients about ensuring that we've got an active rebalancing portfolio, effectively making sure that the winners run, but also putting money into the areas where we see opportunity and growth. Ignoring tax implications. If you've got an investment property, if you've got anything that's gone up, any type of asset, not just the investment property, but any asset, and you've decided to liquidate it and just go, we'll just worry about the tax later. And then you end up on a meeting with me and Phil, and we're going, we've got 60 grand of capital gains tax borrowing. We're not quite sure what to do with it. Just put it in a different account. Set up a different account, put the money into it, and then when the tax man comes asking for it, you've got it ready to go. Those are my two things that I've seen this year specifically that I hope not to see next year, but you never know, probably will.
The things to watch out for next year. Talked about the interest rates. That's going to be an interesting one to watch. Again, my crystal ball is no better than anyone else's, but I think there is probably more danger of an increase, certainly, than a decrease. Something to be aware of. Payday Super comes in next year, which I think is a cool one. Well and truly long overdue legislation, in my view. If you don't know what the hell I'm talking about, this is a common one that we have this conversation a lot with clients, because when you look at your pay slip after you get paid, it has your superannuation contributions relating to that pay on it. And often when we do rollovers, people, where's our superannuation contributions? They're not in yet. And the reason for that is that your employer only has to pay your superannuation contributions quarterly right now. They need to put them on your pay slip in your pay frequency, but they only physically have to pay them quarterly. And a lot of employers do that. So it could be 3 months that they're sitting on your super and that's not in your account. That's a risk for a few reasons. It's a risk that the employer runs up a large superannuation liability across their staff and then can't afford to pay it when the 3 months rolls around. And then we're off chasing ASIC to try and get the money back. It happens all the time. And it's the same as the tax liability. If you don't put the money aside, well, you're in trouble.
That's more prone to certain industries. So a lot of our blue collar industries, so truck drivers, operators, something like that. If you're a contractor, it's unclear why, but it tends to be more of our like blue collar guys. And then maybe they won't actually make the full contribution. So let's say they owe you they owe you $1,500. They might only put like $400, something like that. It's just a sign the business is struggling. We've had heaps of people over the year come to us. We're like, oh yeah, such and such just never paid my super.
Yeah, it happens. So look, I think Payday Super is a long way to help mitigating that issue, because if you're paid weekly, your super from 1 July next year will need to be paid weekly as well, or fortnightly, it'll need to be paid fortnightly. So they need to meet those liabilities straight away. So there's less of a risk really of that, an employer banking up a massive liability and not being able to pay it. So you get your super. But the other cool thing is that that is your money, and you have earned the money at the time that you get paid it. So why should the employer have it sitting there for 3 months earning interest on it? If that's your money, you should be earning that interest. So it should be paid in line with the time that you've earned it. So that to me is a huge positive. I know there are certain sectors out there that are not overly happy about it, but I just figure sort your accounting out better. Manage your cash flow. It's a liability for your staff. They've done the work. You need to pay them. So that to me is a cool one.
Yeah, nice one. I think interesting enough, I don't know if you agree with this one or not, but I have seen less get rich quick schemes this year.
Yeah, it's probably true, actually. There was a lot last year, particularly crypto related stuff getting around. Actually, now that you mentioned it, I haven't really seen much at all this year, which is interesting.
I've definitely I've had less people, less clients be like, hey, Scott, I've got this idea. Whereas I would say the crypto bull run was 21 to 22 and 23. And then I'd say in 24, there was this like rash of just grifters, and they would just slap crypto on whatever. And that was, I think to a degree also, maybe the social networks got a lot better at locking down on those ads too. Maybe that was also a big thing.
Yeah, it could be, because I get peppered with ads for all sorts of stuff, obviously, because the industry we're in, I'm searching for stuff related to that. So I get, the algorithms pick that up and feeds me a lot. But you're right, I've definitely seen less crypto stuff. I've definitely seen less of the old, set up a self-made super and invest in this new hotel that's being built in Bali and, stupid stuff like that too. A bit less of that getting around, which has been good.
I think it might be relevant to I mean, like if you just see the number of there is if you still go onto the ASIC website and they basically have a register of the crazy things that are happening out there. How last week we saw like some director was banned because he was literally trying to raise capital to literally go into, I think it was Papua New Guinea, and get gold from the ships that had sunk.
Yeah, that's right. I saw that one. Yeah, that was wild.
And then it's literally just ASIC newsroom if you just go to that. And that was like, oh, okay. So that's sort of the level where the worlds are at.
Yeah, it's actually funny. Yesterday I was talking to a guy that had booked in, and he was asking me about becoming a wholesale investor and if I thought that was a good idea. The response was a very quick, no way in hell. All that's going to do is take the guardrails off and let you invest in really dumb shit.
Yeah. Do you want to, let's just double down on that. So in terms of the wholesale investor, even if you do qualify, you probably shouldn't. We can give you lots of investments that have got a very normal return with a normal level of risk at an interest rate that's suitable for your risk profile. And I'm specifically not saying percents because everyone wants me to give you a percent, but at an appropriate level of risk. And if it's a double-digit return, it's probably pretty risky. And then if you do it in wholesale investor, then all the guardrails are gone, and it's even the documents don't even have to be right sometimes. It's just
all those weird private equity stuff that you can start to invest in, and all sorts of weird and wonderful stuff that's not available to retail investors. So, I mean, if you really hate consumer protection and really love gambling, go nuts. But otherwise, probably a bad idea.
Yeah, gamble. But then at least a gambling has a better risk return, right? So because, you're risking heaps, but the return's pretty good too. But if you're doing this wholesale things, you're risking a lot, but the return's 12%.
Yeah. And realistically, how dumb is the concept anyway? Just because you earn an arbitrary amount of money or you have an arbitrary amount of money in the bank does not make you a sophisticated investor.
Look, like we said, we've been through this before. It was set up a long time ago. It's a relic. It also hasn't been CPI'd either, which means something like 25% or 30% of the entire country is technically sophisticated or wholesale investors, which is all right, giddy up.
Yeah.
But the summary from that is, for an equal level of risk, we can get you a better return with just a regular retail type product.
Just for a lower level of risk.
Over the long term, and not gambling and not being silly.
Good investment, boring,
Yeah.
If something sounds too sexy, there's probably something wrong with it. If the principles don't change, they've worked forever, they will continue to work.
All right, mate. So wrapping it up, the Australian consumer has been more resilient than the government originally expected at the beginning of the year. Thus, why inflation's now ticking back up.
What Scott means by the Australian consumer has been more resilient is we're all still spending too much bloody money. Calm down. Put your wallet away. You don't want your interest rates to go up, stop buying stuff.
Got to put fuel in the car. But
This is true. You do have to put fuel in the car. And I actually wonder how much of that's like driven by higher rents and all that sort of stuff too. But
yeah, I think
what you can't avoid.
Rents, utilities are going crazy. And, I think interest rates are going to start kicking as well. What about you? What were your surprises for the year?
Surprises for the year. Oh, that's a good one. Probably just the podcast really taking up and the chief people I've spoken to afterwards. Great surprise. It's been good.
So Phil and I, we went to a conference in December 2022, I think. We went up to Sydney. We were in that real fancy 5-star hotel, and there was all these like serious investment professionals, and me and Phil basically walked there in our t-shirts. It's like, oh, we don't fit in here at all. We were the only financial planners in the room. Everyone else was research analysts, and they were researchers. And they did this thing. They basically got a list of here are our most common. Oh, they said, right, everyone, what are your most common questions for the year? And then they actually grabbed the slip of what are the most common questions from the prior year. And at that point in time, everyone was crypto. At this point in time, this was, I think, was it December 23? And they were like, not one of you was asked about crypto. Last year, it was all of you. Isn't this interesting? I think we've actually found some use cases for AI. It's certainly not broad. I don't think we're going to be, I think look, as nice it would be to have humanoid robots cruising around, we're going to have specialized robots. For example, I think in healthcare, around identifying tumors, ironically, mathematics, pure maths, that has been the most effective use of AI. Yep. So but we're super on the edges here, the edges of physics and the engineering. I think in pharmaceuticals, that will make a big difference around sort of DNA strands and optimizing medication. And I think that will help. I think in terms of doing our taxes, still not very helpful.
No. I was just curious before and punched into AI. Tell me about the changes to superannuation from last year, and it quoted stuff that was more than 12 months out of date. So it's probably got a ways to go there. Don't use GPT for your financial planning. I wonder, thinking forward to it, it's an interesting paradox because we're in this world where everybody's talking about greenhouse emissions, heading for carbon neutral, all that sort of stuff. But just about the massive power and water drain of AI as well is kind of really at odds with other conversations about trying to dial down reliance on fossil fuels and all that sort of gear. So that's going to be interesting to watch play out as well, because it's going to be massive demands on power grids. The bigger it gets, the worse that problem's going to get. Massive water demands. It's quite interesting as well. It's probably something a lot of us don't think about.
Yep. So if we're looking ahead, it's been a wonderful year. We want to thank you so much for being part of the podcast. Thank you for booking in. It's been wonderful to have had these conversations. Phil's been basically run off his feet.
Met a lot of very nice people. It's been great.
So gratitude to you as a user, as a watcher, as a participant. Please do comment. We like to see the comments. I interact. I'm a little bit more. I take a bit of a sassy view in the comments a few times. And I don't know. I just people are just why are they? Some guy was one of our it was superannuation secrets 2025, and one of the guys is no secrets discussed here, and I was like,
cool, thanks.
Dude, it's a free video on the internet. Why are you doing this?
Yeah, I stay out of the comments. They hurt my feelings too much. Some guy said I sounded like a real estate agent the other day. It was like a knife to the heart. It's just stop reading.
All right, guys, from our family to yours, we hope you have a wonderful Christmas. Thank you so much for watching. Please do subscribe. Do send this to someone if you think they would benefit from our advice, because that has been a wonderful point of referral as well. People send this to a brother or an uncle or someone else. Please do that.
Yeah, same. Thanks very much for watching. And everyone that's booked in and had a chat with me, really appreciate your time, and look forward to meeting a lot more of you in the new year. Have a great Chrissy.
Thanks, guys.